Well, welcome back, everyone. Welcome back to another morning market open live stream. It's been a hot minute since we've done one of these, and we've got a lot to talk about. The first thing that I really want to talk about is China, because I think that's going to be on everybody's minds today. So we're going to start by talking about China, give sort of my opinion on this. And so I've been reading a lot about this. I do want to just also start by saying, hey, we actually did a drone strike again. This is the first time that we've done a successful drone strike that didn't kill a bunch of civilians in like a year, it seems like, at least one that's widely publicized to kill a terrorist instead of 10 civilians, like what happened last August. So better start to August this year than what we had last August, which was terrible. But anyway, so and it wasn't until the New York Times, by the way, last August, which I know half of you are going to hate the New York Times, but it wasn't until the New York Times last year broke that drone strike killed 10 civilians last August, that the government's like, yeah, we done effed up. Anyway, so most important thing right now, though, is China. This is going to be on the headlines throughout most of the day, I would say. And let's touch on that a little bit. So the big thing with China has to do with, obviously, if you haven't heard yet, Pelosi's going there, right? And so this is, Pelosi's traveling around the Asia region, and she's traveling to Taiwan, which there's been this long-standing dispute over who actually controls Taiwan. By some measures, Taiwan is its own democracy, and it actually is potentially a very good democracy. Some say that Taiwan ranks as a better democracy than Canada does, or a more exact or appropriate a democracy than Canada does. China obviously doesn't like this because China wants control of Taiwan, the one China policy. That's not to be confused with the one child policy, which ended. But anyway, this has led to some saber rattling from China because, see, last week when Xi Jinping spoke with Putin, spoke with Putin. They talk all the time. They're like buddies. Spoke with Biden. Last week, Xi Jinping spoke with Biden and basically said, hey, stay away from Taiwan. Sort of this like medium level threat that he's given before. He's done the same kind of threatening for not just during the Biden administration, but literally for like the last decade. If you remember 2018 with Trump, there was a lot of saber rattling. That's when we got the Trump-China tariffs. And those were tariffs, especially on semiconductors, which added like a 20% surcharge on semiconductors imported from China, which was really terrible during the pandemic and actually exacerbated chip shortages here in the United States and helped China build their local chip infrastructure. So that was really bad. But anyway, Xi Jinping's regularly telling Biden, hey, like, don't, stay away from Taiwan. Don't go to Taiwan. Don't visit Taiwan. And we haven't had someone with the power of Nancy Pelosi, which, I know, again, half of you are going to be like, Nancy Pelosi power. She is the third person in line to the presidency, right? And so we haven't had somebody with that kind of power actually go to Taiwan since I believe it was 1998, which is pretty wild. And so this is, and I think that was Newt Gingrich who went back then. And so this has really led to this big belief that, oh my gosh, this is like a big signal from the United States. They're trying to say F you, China. And so what's China doing in response? China's like, hey, whoa, like this isn't cool. Like, this is what we want you not to do. In fact, by doing this, you guys are, quote, playing with fire and you risk burning yourself by going to Taiwan. All right. So, obviously at this point, it seems relatively guaranteed that Pelosi's actually going to go, though it's still like somewhat unconfirmed whether she's going to go to Taiwan. The argument is that China could do some kind of like aggressive military drills, like back, I think it was in 1996. They actually shot missiles over towards Taiwan and purposely crashed the missiles like right off the coast of Taiwan. And that would probably make people very nervous, like U.S. security and, U.S. military as well as Taiwanese military. And so there's not so much a risk of like a direct conflict, but there's this risk of an indirect conflict that like, oh no, the missile you shot that was just supposed to be like a big FU warning accidentally hit one of the United States's, F-35 fighter jets, fifth generation fighter jets. And now a missile basically struck a fighter jet from America. And is that like potentially a war? And is there a response to that? Anyway, usually what happens, like I would say with 95% certainty, usually what happens in this is it's like headline media stuff. China's like, how dare the United States do this? And then they start running like pieces on Nancy Pelosi in China about how like she's evil or whatever, and the United States is evil for doing this or whatever. And then they have a bunch of military drills to show their people, look how strong we are. Keep in mind, I don't really care what you think. The U.S. military, in almost every single way, is superior to the Chinese military. They have definitely started spending a lot more money, though. They spend like, we spend like $800 billion a year on our military. They spend like $225 billion a year on their military. So they're definitely getting better. They're spending more money, which, good for them. But look, nothing's going to happen here. It would be very, very stupid. And both sides know this. So it's not something I'm really concerned of. In fact, if you follow me on Twitter, which is @RealMeKevin, yesterday I tweeted something to the effect of, without pulling it up right now, something to the effect of, hey, if we have more saber rattling from China, which is basically the same kind of garbage that we had from 2018, I'll take the buying opportunity because it literally has nothing to do with our economy. Obviously good if there were, but we think that to be a very small edge case scenario. Anyway, so that's my thought on China, and I know a lot of people are going to be wondering about that, so I wanted to cover that. Maybe we'll do a deeper dive on that a little bit later, but or in a different video. But those are some of my thoughts on it right now. The big thing, other than that, is now sort of trying to figure out, hey, is this last little rally that we had in the NASDAQ and the S&P actually something sustainable, right? So I think it's time that we update the Fibonacci's here. Okay, it's been a while that we've had the fibs kind of in the I should say inappropriate position, and that's mostly because we've spent so much time bouncing hard off that 0% line. We had 4 solid bounces off of that a lot of folks are saying, hey, you know what, those were some pretty serious lines to pay attention to, but more than just the line in the past is not something that we should just constantly be trying to pay attention to. So what we're going to do is we're going to kill some of these lines. We're going to, instead of leaving the fib where it is here, we're going to draw a nice little support line there, because we know when we get back there, oh, wow. Yeah, look at that. It actually could end up serving as a resistance, which, look at that. That's literally what you had. That's actually incredible. Before I remove the 0% fib line, look at that, folks. The 0% fib line right here. Here's your bounce on Feb 24, March 8, March 14, and then you had some rough bouncing over here in April, and we were pretty confident in that 0% fib line. But look at that, folks. We are now getting rejected by it, given that the S&P, or this is at least the NASDAQ here, is negative 1% this morning. It was slightly negative yesterday, basically flat. You can see that rejection actually happening. So really interesting here. So what I'm going to do is I'm going to kill this fib. And then what we'll do is we'll actually, let's see if we can unlock this darn thing. Let's see here. I don't want to delete all drawings. I just want to unlock this thing. I don't know where the darn lock is on this. I've been using TradingView, so like I've really kind of been enjoying TradingView, especially the little widgets they give you on the phone, which I think are kind of cool. But oh boy, I need to figure out how to unlock this. Anyway, so I'll figure out how to unlock that later. Yeah. Oh, there it is. I just saw it. There it is. Okay, see, there it goes. Unlock. Okay, good. Well, see, the good news with that is there have been so many times where I've accidentally dragged the fib lines. And so it is nice to have a lock, but boy, oh boy, they did not make that very intuitive to unlock. Usually I don't. I like to leave them. But anyway, what we're going to do is we're going to draw a little support line. I think 318 is that number where we really want to place this roughly. There, 317. That works. 317.95. So that to me is a pretty strong support line for the QQQ, especially since right now we're literally getting rejected by it. That's pretty impressive. So, and then you can see we got pre-traded away over here. All right, now we can draw a new one and kind of just see what I'm curious is how much did we actually retrace going back to where where we were previously. So let's take a look at this. We had our bottom here in bloody June. And it looks like we've retraced. Look at that. We almost have a perfect alignment there of a 38.2% retracement and that previous fib line that was so famous this year. Let's actually make that famous line yellow. There we go. Then you can see it a little bit better. Isn't that incredible? Yeah, that's really neat. So, okay, so some basic technical analysis here, just kind of showing us that, yeah, wow, we are definitely testing a very, very important line. And some are saying that if we can get and stay above that 318, potentially after the China uncertainties, that we could actually see a real confirmation of a bullish rally and bottom, and not just some kind of like bear market rally, right? So that's good, as some like to say, dead cat bounce, obviously. Okay, so we'll see. That does beg the question then, is today potentially going to be a little bit of a dippity doodle day because of Pelosi? I don't know. My opinion is this is nonsense. Okay, like this is the same kind of stuff, that the same kind of trade that we saw in October of 2020. Let's go back there for a moment. So here you go. Wow, it's so weird looking back at some of these prices. So here was March of 2020. We're on the day chart. Let's go to September, October. Here it is. All right. So September and October dips were right here. And those were painful. I mean, this was a moment where Tesla had dropped like 30%, 35% maybe. You had this follow-up in October. These were some rough times. But what was interesting was you began this trend that was really remarkable. It was a really remarkable trend, and that's symbolized by these two blue lines here. And in October, this was really the pre-election FUD that we had. And this pre-election FUD ended up really being nothing. I mean, sure, like everybody was freaking out. Like, what if there's not a peaceful transition of power? What if there's a contested election? And sure enough, we ended up having a contested election. But boy, oh boy, it made for a nice little buying opportunity. I mean, if you were buying there, you were buying QQQ at like 280, 260, which was like the depths of June over here. Look at that. In fact, the 0% to 23% retracement line here from top to recent bottom is anywhere between 268 and 300. And now we're almost back to that 318 line. Really, really cool. So excited. I'm overall pretty excited for the market. I'm mostly in the market too, for those who aren't aware. I try to make that really clear, but still sometimes I get comments from people who are like, "Wait, so I thought you sold everything." And I'm like, really? Like, did you watch like one video in January and never come back? It's possible, I suppose. Anything can happen. But anyway, okay. So let's. One thing that I want to do now as well is I want to look at the Econ Calendar, just see what we have ahead, because the Federal Reserve is not going to meet again until September, like September 21st. And what I think is really interesting about that is really we just get some blah, blah, blah from the Federal Reserve over the next really 7 weeks, basically them just yapping and trying to, keep either yield curves or break evens or ultimately the stock market in check. So, as is typical, as soon as the Federal Reserve is done with their meeting, you start getting some of them that come out and start yapping about how, oh, wait, we still have work to do. Like, for example, immediately after the blackout period, Bostic came out and said, we're not in a recession and we have more work to do on inflation. I'm like, man, I will never forget the day when the U.S. went into recession. I was on a train. It was the Eurostar, which I absolutely do not recommend you take if you have lots of baggage. Very bad idea. Anyway, if you're not familiar with the Eurostar, it goes like 75 meters below the sea between France and England. It's kind of cool. And I didn't get a headache this time. But anyway, looking forward. What do we have to look forward to? Well, we have a lot to look forward to. Like, for example, Webull sent me an email. I haven't even fully read this email, but I think it's kind of funny because I'm like, man, I remember the days of like get 2 free stocks. I remember the days of get 5 free stocks, 4 free stocks, 5 free stocks. I remember the days of even 6 free stocks, which was recent. Well, I just got an email. It is now, folks, get 12 free stocks valued up to $30,600 by going to metkevin.com/Weeble. That's incredible. That offer is valid in August. Please shout out this exciting offer. I mean, it is kind of interesting. Open an account with Weeble, get 2 free fractional share stocks, each valued at $300 to $300. Then deposit any amount of money and receive 4 to 10 free fractional shares valued between $7 and $3,000 each, right? So at minimum, that's like 6 plus 28. At minimum, that's $34, all the way up to probably $3,300-ish. I don't know. That's wild. Anyway, okay. So what do we have on the economic calendar today? Well, on the economic calendar today, we have the JOLTS opening. Okay, this is actually a big deal, and people like to bag on the JOLTS indicator, but the JOLTS, like, let's make this clear. By this point, you should know very clearly that unemployment is a substantial lagging indicator, right? You go into recession, then companies are like, oh crap, things are slowing down. Then they start laying off employees. Okay, we know that employment is a lagging indicator. However, the JOLTS, by some people's opinions, could be a leading indicator of an inflection point of the Federal Reserve's actions. The JOLTS is the job openings indicator. We are expecting today to get to 11 million job openings. That's what they told us last month. Well, last month it came in at 11.254. Still plenty of job openings. Now it's at, the expectation again is at 11, and maybe we'll get it this time. Or we won't. I don't know. But anyway, I hope you liked the intro, by the way. I spent some time doing that on the plane yesterday. I thought it was really cool. Since I don't really hear anyone reacting, maybe I can do this. Hold on. Does this work? Here we go. All right. Got myself a little crowd cheer there. I don't know if that was listenable. Anyway, okay, so the JOLTS comes in at 7 a.m., which is in 55 minutes. The market opens in 25 minutes. Let's see if we can take a peek. I haven't taken a listen on over to either Bloomberg or CNBC in a while. In fact, it's been so long that I've been sitting in here that I actually have to change the channel from the stupid default channel that it comes with. But that's okay. I will also try the Bloomberg video. Oh yeah, let's try that. That way we have Bloomberg, CNBC, and we can pop between the two. All right, let's see if this works. Is it this one? No audio? Wait, you guys can't hear that? Oh, was it too low? Oh, that's a bummer. I could hear it. How come you can't hear it? Maybe it might have just been too low. Hold on, let me try again. Good. What? Still no. Wait, seriously? How could you not hear that? All my levels are saying you should be able to hear that. That is funky. That is really, really interesting. Were you able to hear the intro song? Like, if you scroll back to the beginning of the video, could you hear the intro? And maybe if not, like, could you say no, intro was silent? Doesn't make sense. How could that not work? Cannot hear the slide. The slides were silent? What? So I could hear it, but you can't hear it? That doesn't make sense. All right. That doesn't make sense. Okay. Well, interesting. So you could see the slides, but you couldn't hear them. That is a bummer, because that was a really good intro. All right. Well, I don't know why that's not working. Oh well, then we will try. We will try something different. Well, welcome back, and nothing works. That's all right. All right. So redo intro. Yeah, no kidding. Pictures were great though. Thank you. Love the pic note on it. Huh. That's so weird because like I can hear it and it says it's coming through, but it's not. So okay, well I'll have to figure that out later. Let's see audio. Oh, figured it out. My audio is probably like 10 times better now as well. So I'm gonna we gotta redo the intro. The intro was sick. Okay. And then I promise we'll get to the sticks. But now it should work. But first we're gonna test it here.
To recover from the big lockdowns in the second quarter, the most obvious one being Shanghai. But we saw that hit the manufacturing now, and that spoke to two things. It spoke to underground problems around supply chains and the like, but it spoke to weakening global demand too. So China's now being hit externally by people buying less stuff made in China. Domestically, the real estate stuff.
This guy's boring anyway. So what happened was you've actually been hearing me through my laptop mic. It was set to my laptop audio input and not my switcher input. So I could hear everything the switcher was hearing, but you couldn't. That's interesting. So you probably didn't hear the iPad crouch here either. Interesting. Very interesting. Yeah, and my sound should be like substantially better now. Anyway, okay, that's all right. That's all right. It's just the little curves of getting back into it with the group. Okay, give me like 52 seconds here because I want to play this, but not only do I want to do that, I want to make sure I can get CNBC up. So give me 1 sec here and enjoy this for a moment, and I will be back in a minute.
Don't be scared. Right now, I don't know if I'll ever arrive. Where the grass is green, we're still alive. I hope I'll see you on the other side. I know that I'll be paying for the ride into the black hole.
Okay, that was much better. I imagine. I heard it would sound both times. Anyway, okay, thank you for living through the technical difficulties. If you're just now joining, remember in 50 minutes we have the JOLTS indicator, which comes out, which is expected to be a leading indicator of a a Fed U-turn to some degree, because the Federal Reserve is watching the labor market very closely. And what they want to see is they want to see tightening. They want to see the JOLTS indicator go down to get back to a level that they consider more neutral. Now, Jerome Powell gave us a hint as to what this neutral level would be. In fact, we watched this live together. And I said the answer is a 1-to-1 level, which is where you have one job opening per one employed person. Right now, we have one unemployed person per 1.9 job openings. And that's an imbalance. And that suggests that, well, if you put pressure on companies by raising rates and tightening monetary policy, then you push down the willingness of companies to spend money. And this is why you're hearing about hiring freezes at Google and Facebook and Tesla, even layoffs at not only just tech companies, but Ford or Rivian or whatever. And so you're trying to push down the level of openings that you have and bring that in line with how many unemployed people there are. And that's deemed to be a little bit more of a balanced economy. So we've already heard that Jerome Powell thinks we're at a neutral level of interest rate now, though we do expect to go beyond neutral to about 1.1, 1.2% above that, based on the last summary of economic projections from the Federal Reserve. But also we are expecting this JOLTS number to be something that tells the Fed, okay, yeah, what we're doing is working. Because remember, what the Fed does, it acts with a lag. And a lot of folks forget that. We think, oh, that's it. Interest rates went up and it's time for, the market to react. How the Fed responds is happens in such a delay that, like, the way I like to picture it, if a house is on fire, the Federal Reserve is kind of like, oh no, the house is on fire. And they're like, as the house is on fire, like plumbing little drip irrigation lines. And like, all right, we got the drip irrigation lines in. Meanwhile, the house is still on fire. And then they go outside and go, ee, 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 and you get like the little drip of water. And it's like, eventually it'll put the fire out. It's kind of sad. But yeah, okay. So that's going to be something that we pay attention to. Again, that's at 7. We will be covering that here. So we'll see that live together. We will also, obviously, we covered Pelosi, and that being the big thing that I think everybody's paying attention to today is Pelosi's Taiwan visit. If you haven't seen that part of the video yet, you can scroll back. We covered that in detail, sort of my thoughts on it. And you are going to see a lot of headlines circulating around this. U.S. equity futures slid Tuesday amid escalating U.S.-China tension with Taiwan, blah, blah, blah. Okay, fine. I think the big question that we have to now also ask ourselves is this, as we did with the technical analysis, is this going to be the kind of market where we're able to say, hey, this is not just a relief rally? And so today's going to be one of the tests of that. And the post Nancy Pelosi period of time is going to be a test of that. So if you are somebody who's like, hey, Kevin, look, I'm out of the market. I feel like maybe I missed the bottom at the end of June, early July. What do I do? Maybe what you do is you see what happens with Nancy Pelosi, because here's the reality. The odds are nothing's going to happen with Nancy Pelosi. But the reality is you really shouldn't feel bad about potentially having missed any kind of bottom, because if you look at the fibs the way we have them, we are literally sitting at that where we had a quadruple bottom and now getting rejected by. So sure, maybe you didn't get this little peak bottom over here, or maybe you DCA'd a little bit and you're like, dang, wish I bought more or whatever. I would try to put that behind and just look at the fact that, hey, you're able to buy here at this yellow line, which is really indicative of May and March 2021 levels when the market was bloody then. Like, we're not at a horrible place. So if you're thinking to yourself, hey, like maybe if things go well with Nancy Pelosi, then that's going to be a signal for me to kind of get back into my little DCA mood and start getting out of cash a little bit and start getting into this market again. And of course, then we could all be happy and we can all cheer. See, now it's working. All right, good. So what else do we have going on? Well, so here's Enphase. So I'm actually shorting Enphase right now, which might come as a surprise to you because Enphase is one of the companies that is positive year to date. It has gone euphoric, in my opinion. Enphase is one of the few companies that's actually sitting at November of 2021 levels. I made a lot of money on Enphase the first time I sold, a lot of money on Enphase the second time I sold. Because I bought in like February and then sold it at like 196 or whatever. But obviously now it's like 280. And it's like, well, damn. But anyway, I think that even though Enphase has substantial demand, a lot of excess demand as well, I think the way the stock has moved from a technical point of view is euphoric. And I think a slowdown in the real estate market combined with recessionary fears could potentially finally start creeping into maybe like Q3, Q4, maybe even Q1 earnings for Enphase. We're not there yet. We just covered Q1, Q2, which were phenomenal. Okay, we're really, really good. I mean, we are talking margins going up. We're talking, everything's going right for this company. They're a great company. You do not want to bet against this company in the long term. I really, really like them. So don't want to bet against them in the long term, but I'm also kind of using it as a little bit of a hedge, because if we get, a nice little negative 2% QQQ day today, or even a negative 3%, because, oh my gosh, Pelosi's actually in China, whatever, then maybe that'll have some short-term tendies, and I'll take those. But anyway, that's something I'm paying attention to right now. So next, let's see here. Ooh, course member is asking a question. Has Bloomberg released the CPI consensus yet? So probably not. I was gonna say usually it's much closer, like 5 days before, but I'll look right now. So that was it the 10th or the 11th this time? I think it's the 10th. I think it's Lauren's birthday, which is the 10th. Let's find out. Okay, here CPI. Oh, well, they have a survey so far. Interesting. Headline CPI expected to go from 9.1 to 8.8. You've got core expected to go from 0.7 to 0.5. And wow, oh my gosh, month over month CPI expected to drop to 0.2%. Holy moly, that would be nice. Woo! That would be really incredible. Let's take a listen over here, just for old time's sake, to Jimbo. Let's listen in. Let's see what they have to say. I don't even remember how to do this. Oh crap! Is it this one? No. Oh dear. Another little technical difficulty. I have no idea which level it is. It's not that one. Okay. Never mind. We don't need to listen to Jim anyway. What's there to listen to with Jim? You know what we'll do? We'll go back to listening to Bloomberg. That's what we'll do.
So that's really hurting hard, and like you say,
earnings reports are suggesting, or is it going to stay low as Fed officials keep pointing to?
Well, Fed officials speak through this morning and into the afternoon. Gene Tanuza will hear from Daly, Evans, Mester, Bullard. Of those guys a little bit later, are you expecting some pushback to the rally we've seen? Because that dominated the conversation after Wednesday, and Chairman Powell unleashed another equity market rally. Spreads were about 100 basis points tighter from the wide of the year. Gene, are you expecting some pushback later?
I do, and that's been consistent with the commentary we've received since the meeting last week. The Fed's not done. They think there's more interest rate hikes to be had. Yes, neutral is a critical milestone at 2.5%, but as Summers and others have pointed out, neutral is at best an estimate, and the Fed wants to get at least a little bit into restrictive territory to bring inflation down. So their work is not complete. Inflation is too high and unemployment is too low for them to stand pat at this stage. So I suspect that the commentary that we're going to hear this week from Fed officials is going to put pressure on the front end of the curve at this stage.
What does it leave the credit market, Gene?
Well, I think that's depends on how hard that they push at this stage. I think investment grade markets, frankly, are already pricing in a fair amount of slowing. I think it's the high yield markets where we look and say, well, we're really not pricing in much of a default cycle. So that's the market that would be vulnerable to more significant hikes if the Fed wanted to stay on that 50 to 75 basis point hiking pace.
Colin, what's your take on that?
I agree with that. It doesn't look like the high yield market is pricing enough of what we expect in terms of Fed rate hikes and the potential for growth to continue slowing. And the reversal we've seen in high yield spreads over the past month was pretty huge. And we're looking at average spreads that are just that. They're average. They're close to the 10-year average. And if you look at in the post-financial crisis era, previous peaks, we're still well below the previous peaks, like what we saw during the European debt crisis, what we saw in 2015-16 when oil prices were plunging. Now, we don't expect them to necessarily get to the March 2020 levels, but that just does suggest that there can be some upside there. And as Gene mentioned, it doesn't look like it's pricing in a pickup in defaults. Now, defaults today are still at very, very low levels. But given all of the risks we see, rising borrowing costs, rising labor costs, slower demand, we do think the default rate should pick up, and we'd expect spreads to rise to account for that.
Hey, Colin, how useful are default rates in predicting anything? I always think of them as the barn door after the horse is bolted data point. Why do people always say that defaults are low and therefore it's okay? Of course they are. But ultimately,
it's a really good point, by the way. It's like kind of a lagging indicator, defaults, right? This is why I like looking at bank allowances for defaults, what banks think defaults are going to do.
Metric. So we're looking to see where is that rate going? And is the level of spread that I'm receiving as an investor, is that going to compensate me for, default induced losses, credit losses because of those defaults? And right now, given the level of spreads, I just don't think there's enough compensation there, even if we do see defaults rise from, say, the sub 2% levels that we're at right now to the 4% plus that we can see, not necessarily later this year, but probably into next year.
It's been a frustrating part for a lot of people in the credit market.
All right, let's go ahead and jump on over here. Now let's see if we can get Jimbo working.
What you're doing is you're trying to get emails that trap Musk. Now, remember, Musk needs to find an email in Twitter which just says, we showed him that 5% of the users were phony. It's really 20. They will not find that because it's not. Unless Ned Siegel is a mole, and he's not. You know, where he's a double agent for Musk, and he's got actually saying it's 25 in that boat. The board of Twitter wants that thing sold so badly. I have no idea what Musk is talking about. And now when they're picking on his friends, that's like pulling the wings off of flies. Man, can you imagine? You're like, every email of those guys could be. Do you think that what? Don't you think there's some email in there which just says they're a bunch of idiots? Can't you make them better?
Lonsdale says, I had a couple of snarky comments. But we're going to find out more.
I want to see everything, and then it really proves you should never. David Faber always just says yes or no in his emails. It's horrible to get email David. It's like why? Letter Y, letter N. Even if you ask him if he went swimming this morning, he'll say why.
Yes. Not his first rodeo.
But these guys.
All right. So I want to add some commentary on that. The Elon problem, I think, is a big deal for Elon. I think he's got a lot of headwind in his court case. And I think there's really one major reason why. And people, I don't know, sometimes I think people get mad at me when I suggest this because, it's like, here's the thing. If you're an Elon fan, you're always supposed to be an Elon fan. Like, you're not allowed your opinion. I honestly think this is why I could buy a new Tesla and literally have a perfect safety score and not get the full self-driving because it's just like, oh yeah, his computer is broken. Okay, all right. I like to, I think the best thing you could do is be critical of the things you love, because then if you're investing in what Elon is doing, you're aware of, okay, where are the potential dangers and pitfalls, right? But if you're part of like the cult that is Elon supporters, it's oftentimes very, if you say anything bad about Elon, that's it. You're a fake. You're a mole. Anyway, so my thesis, and I think it's very, very simple. Here's why Elon is screwed. Okay, it's simple. Twitter had never, ever had an obligation to actually figure out how many bots they had. Never. They never had that obligation. Now, if so like they could literally say like, hey, window cleaner, nothing against window cleaners. Okay. Pro window cleaners can make good money. Hey, window cleaner, in your experience, how much would you say plus or minus you interact with bots on Twitter, or you see bots when you use Twitter? I don't really use Twitter. Well, if you had to guess, I don't know, 5%. All right. In theory, that they could say that. They could say, hey, we did a survey and we briefly looked. We didn't really go deep into it because why would we? Why would we try to inspect something? The company's growing. Let's focus on making money. We don't really need to check the plumbing because the plumbing's working. And we got an opinion that says the plumbing's working. The bathrooms work, right? They have no obligation to actually go out of their way and suggest, here's exactly how many bots there are. They have no obligation to do that. And so Don Allen here says that I think the issue is Twitter not being forthcoming with the requested data to verify the 5% number. I think this is an argument that Elon's team's going to try to make, but Twitter's going to go, dude, we gave you everything. Here's the 5 terabytes or whatever they're called of data or whatever, the 50 terabytes. I don't know. It was something crazy, right? It's like, we gave you everything. We don't have a formula or a perfect way of estimating the bots. This is your problem. We gave you everything, but we never said that we knew with certainty what it was. That's your business. And if you waived, due diligence, then that's your problem. Now, Elon has to make the argument that, well, you guys should have known, or maybe you actually do know. And that's how Elon wins. If Elon can suggest you knew or you should have known, and the judge agrees, then Twitter will lose. But only then. All right. Didn't they report to the SEC that they had 5% bots? they can lie. They didn't report that they had 5% bots to the SEC. They said in their SEC filings, we think the bots are around 5% based on very arbitrary, essentially surveys that we've done. But it could be totally wrong because there's a lot of opinion that went into what we did. That's roughly what they said. I'm paraphrasing what I remember. You can pull up the exact quote, but it's roughly that same kind of thing. So they're basically telling you, we think it's this, but we literally have no idea. That's what they said in the SEC filing. The SEC filing does not help Elon. Can't he get out of the deal for $1 billion? If both sides agree to walk away, Elon has agreed to give $1 billion. But if Twitter's like, we don't care about your $1 billion, we want 5420, they could sue for performance, which is forcing him to go through with the contract. It's going to be very, very interesting. And it feels like Twitter is screwing Elon because that is in the best interest of Twitter shareholders. Twitter should put the screws to Elon for the benefit of Twitter shareholders. And that's their job. So you can't blame them. You know, if you were the CEO of Twitter, you'd be like, put the screws to this guy. You know, you can't blame him at all. All right, folks. We're 2 minutes away from the market open. I'm excited. I'm excited. This is like the first market open we've done in a hot minute. I think there's a lot of nervousness with Pelosi and such going on right now. So it's a little unclear what's going to happen. Maybe what we need is some like suspenseful music. Does this work? I don't know. Can we hear that? I hear it. There we go. Okay. So suspenseful music and the stocks. All right. So what do we got here? We got QQQ down about 0.2% right here. Tesla down about 1.17. Look at it sit on that 880 line. Let's pull off of suspenseful music here for a moment. Look at this. This is an old line that we have right here. So here's the Fibby, which for Tesla is also a little messed up. We'll have to redraw the Fibby, but you've got a really nice higher lows right here. You've got a little look at this perfect convergence pattern there on Tesla. Oh, we're going to have to draw this. Look at that. Lower highs, higher lows, breakout. Pretty incredible. All right. We have 10 seconds to go. Let's get Jimbo up. Let's see what Jimbo's got to say at the open.
Hard to hear. I know these people are covering. It's a great, joyous day for them. I have them on. But there's a very, very serious charges have been levied, and I wanted to clear up at least the MasterCard.
That's good. We continue to await more specific comments from Visa itself. Yeah. There's the opening bell, of course, on the CNBC Real-Time Exchange. And the big board, as Jim said, global logistics company GXO, first anniversary of the listing, and you have them on tonight.
Yes, I got to know. I mean, some of the freight forwarders are telling me that business has slowed dramatically. Okay, some have said that to me. Again, that would be in keeping with mine.
Right. Well, so we're about probably what 8, 7. I'd say maybe 70% on the red side. Let's go ahead and just look at the actual sticks here. So we have QQQ. Not exactly sure what it wants to do, which isn't a surprise. Tesla looks like it's rotating red slightly. Yeah, it is. But again, we're sitting at this 880 longer term support line that we've drawn, which that line, ignoring the Fibbies, goes all the way back to the previous high that we had in January of 2021, served as a bounce. It served as a breakout catalyst in October of 2021, served as a bounce in December of 2021, failed around January of 2022, served as a resistance in March of 2022, and slight little shelf in April of 2022. And now we're kind of getting rejected by it, but we're sitting on it right now. Okay, so we got to pay attention to that. 880 line's a big one for Tesla. Enphase going back to rally mode. Look at that. It's down about, that's kind of all over the place right now, down between 1/3 and 2/3. So QQQ only down 0.5% right now. People are looking at the red and going, you know what? Let's go with this. Let's take it. Yeah, this is good. I think we might. I mean, here's the thing. What I've noticed in this market is the first like 5 minutes we get rally mode. It's like everybody's like, oh, it's red. Ding, 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 ding. Go buy. And then it drops like 15 minutes in. It seems like the best time to buy is like the M1 Finance window. Let me see what if I have that up. M1 Finance. Oh, I don't have it on this phone. That's all right. Well, I could probably log in anyway, can I? No, it's gonna take too much time. I'll try that really quick. Yeah. Anyway, I'm pretty sure the M1 Finance window is now, and it oh yeah, okay, no, that's wrong. It goes through like 15 minutes after, but you have to put it in like right at the beginning. And it's funny because it goes through 15 minutes after, and that's oftentimes when you have a little bit of a trough in the market. Not always, obviously, but it's kind of entertaining to watch that happen. Yeah, all right. So, okay, so we've got what seems like a market that's trying to go green, but still slightly red. Let's go jump on over to the SPY. Let's see how it's doing. Yeah, same thing over here with the SPY. Here's the zero. We got to really clean up these fibbies. So let's see here. Let's do that a little bit. Let's get rid of the old. We're at the old 0% line here, which it's not as perfect as the QQQ. So I almost just want to get rid of that one, which I might do later because trying to find where the lock is on this is really quite annoying, and it's just not worth going through right now. Okay, so looking at the QQQ, which we did earlier, we had some beautiful, our Fibonacci perfectly aligned almost with our longer term support level here. QQQ is just going rally mode here. Tesla's almost, I mean, Enphase just went green. Tesla's about to go green here. People are waking up going, nope, this is buy time. And let's see if we got any kind of crazy ralliers. I know we had Uber report. Look at this. Pinterest reported yesterday. Pinterest up 17%. I think they moved more on this optimism that somebody took a large stake or a certain fund took a large stake in the company than anything actually fundamental. But okay, hey, there's been a lot of pain in the advertising space, so that's great. Uber's been killing it. In fact, I have Uber's results up that I want to go through. And I think what I briefly want to do with Uber is just see what we actually have in terms of a loss here. Because we know even though they killed it on active users by about 10%, they're still not making money. And the question that a lot of folks have is like, when are they actually going to make money? So let's look at the chart here. So this is as of the chart's a little split, which is annoying when that happens, but that's okay. So we take a brief look here. We've got the 3 months ended June 30th, either comparing to 2021 and 2022. So 2021's on the left, 2022's next. See, look at that. That's very interesting. You've got a loss. You've got a net income here. Net income attributable to Uber Tech, blah, blah, blah. Okay, net income attributable to common stock. All right. So basically, you went negative. You had a negative $1.32 EPS. Last year, you were at 61 cents. So what happened? How did all of a sudden, coming out of the pandemic, you look at this, folks, double your revenue, but your costs go to the freaking moon. You doubled your revenue, but you 2.5x'd your expenses. So that's a 2x right here. This is a 2.5x right here. So cost of revenue got hit a little bit, actually quite a lot. Research and development. I've always wondered what they do at research and development, but that's okay. G&A went up a little bit. Okay, but that's expected. Depreciation, amortization. What else do we have here? Total cost, loss from operations. Do we have a large, what is this here? Income before income tax, provision for income taxes. Interesting. So what's this? Other income. Okay, so we had something here. So other income or loss, that some kind of impairment must have hit them here, because that's a big deal. If we didn't have this other expense right here, whatever this is, you'd add 1.7 in, they'd still be losing money though. How? So that blows my mind, is even if you added that back in, they'd still be losing money. So this is something that I really want to go deeper into Uber, not necessarily right now because we've got the JOLTS indicator coming up. I want to watch what's going on with the market. But it's interesting to me that their sales and market, and this is actually a really good thing, okay? First of all, look at this, folks. Their sales and marketing decreased, but their revenue doubled. Now, a lot of that is probably because of reopening, right? Like ordinarily, if you have a company that spends the same amount in advertising and their revenue doubles, it's probably a good company to be paying attention to. Enphase is very similar to that, and I love that about Enphase. But I just think they're overstretched right now, and I think they serve for a good potential downside protection. And of course, if we rally, I'm like 99 of my portfolio, I'm 99% long and like 1% short. So anyway, usually that's a good thing, but it probably has to do with reopening. And I'd love to know what that little impairment is. But again, those are things that we'll look at separately. Maybe we'll do that on like the course member live stream. We'll go into this a little bit more detail. And then I'll read their earnings call as well. So I do want to go through this, but not necessarily right now. We'll see quickly. Oh yeah, here it is. Headwind relating to Uber's equity. There it is. Okay, so they took a write down on stocks, primarily due to unrealized losses in Uber's Aurora, Grab, and Zomato stakes. So basically some venture capital investments that they just took a large write down in, but they would have been negative anyway, even without that. And I think that's the larger thing that makes me scratch my head a little bit, that I'd want to go into their earnings call to see a little bit more about why do you double revenue, expenses 2.5x, and you still lose money. Yeah, total costs and expenses about 8.8 bill, and income was about 8 bill. That's wild. So, well, that's just something to pay attention to. Okay, all right. Wow, the spammers are now donating. You see, this is what happens when you turn off like the public comment section. These losers, like this is a scam, by the way. Okay, this AMZ29K, this loser donated money, not much, but donated money to advertise their little scam. Anyway. Stay away from that kind of crap. Oh, the comments are so spammy. Like, I think if YouTube, or if what's his name, Elon Musk wants to fix a bot problem, go fix freaking YouTube spam. It's a disaster. Yeah. Ugh. Okay. So interesting, seeing a little bit of softness here in crypto. I'm gonna look at the day chart here. Crypto saw, coming off obviously its bottom. We've had a nice like $6,000-ish movement in BTC, which is about 30%, which is pretty decent. Does not at all hold a candle to what we've seen Ethereum do. Ethereum has absolutely killed it. I mean, they were at $900. Look at that, $880. I mean, that's a double almost a double from the bottom. I mean, obviously, you can't perfectly hit the bottom with like all of your portfolio. It's like, oh, yeah, you DCA on these things, right? But boy, oh boy, that is a pretty incredible move. Enphase now dropping slightly red again. It was just green. QQQ still going, but leaving Tesla kind of behind here. Volatility up 5% today. Good if you own options. You've got Pinterest up 16%, DoorDash 6.5%, Roku. Boy, oh boy, they got smashed on earnings. Roku now sitting at $75, $4.71% up. AMC up at $12.70. Let's see if there's anything spectacularly moving around here. Affirm's bouncing around. Where are we? $27. Okay. Ooh, Dave & Buster's. Where's Dave & Buster's? Redfin, I still feel like is one of those stocks left behind. But if you get any kind of softness in real estate pricing, they have a lot of real estate on the books. So you can get hit by that, especially if you get a little anxious that you need to dump some more inventory. Especially you start looking into markets like Austin and Boise. That's really where it seems like you're starting to see a little bit more of these inventory increases or even declines. In fact, you could take a look on screen here, and you've got Boise inventory surged 179%. Austin, Texas rose 218%. Phoenix area rose 156%. These are in inventory levels, right? So kind of neat. You're starting to see a little bit of that softness in the real estate market, which you would expect. Okay, so what else do we have? Let me see what the suits are saying. In the meantime, let's go ahead and take a brief listen in over here to CNBC.
Big step to getting to investment grade. Once we're at investment grade and we know that we can have access to capital in good markets or bad capitals, listen, then we're going to look at shareholder returns. Ultimately, we're here for the shareholders. And, it's my opinion that the shares represent a great buying opportunity. I bought a bunch personally. And once we have a rock solid balance sheet, then we can look at capital returns that help shareholders one way or the other.
We talked a moment ago about return to work and office capacity. Do you think that's driving some of this? Or is that still iffy?
I think the broad reopening is driving this. So it is when we look at use cases, going to the airport, going to work, going out at night, etc. It's just the reopening generally is happening. So the strength isn't coming from one sector or the other. When we look at markets, the East Coast markets in the US, for example, are much stronger than the West Coast markets. And the East Coast markets do happen to be return to work markets. West Coast is a little slower in terms of return to work.
Isn't Europe going to be behind on that front? Do you think?
No, Europe is returning to work. The whole debate of like working from home in Europe is not as much of a thing.
Sure.
The European markets, the UK, France, etc., are incredibly strong. We're very optimistic about our business in Europe.
How does that square with German retail sales collapsing, worries about war, electricity prices, macro worries in Europe?
I think it goes to the shift from retail to services as well. And remember, our business, for example, in Germany, it's really young. Our business in Germany, Spain, there's a ton of growth ahead of us, both in terms of geographic penetration, but then also new product penetration, getting taxi on Uber as well, hailables too.
I mean, he's not wrong. Like, I was just in Germany, London, Paris. It's hard to get a freaking Uber. My goodness. Like, you're better off getting into regular taxis, especially in London. Oh my gosh, there are taxis everywhere. It's so easy to get into a taxi. But it's weird because like the taxi stops and it's like, okay, we're here. And you're like, okay, cool. See you later. And you're like, oh, wait, they want me to pay, so you have to go through that extra step. And that's something that Uber actually makes quite nice. Interesting, their balance sheet, their current assets roughly match their current liabilities. 8.8 billion in current assets, just at a quick glance, 9 billion in current liabilities. I mean, they 38 in total assets, 23 in total liabilities, but some of these assets include their investments, which they just took a write down on, 11.8 billion in long-term assets, investments. So they're definitely trying to prop up that balance sheet. But in terms of like current cash, if they keep burning money like they did in that last quarter, they're going to burn through their cash pretty quickly. See, let's see here. They're net, well, I mean, but then again, let me see here. Let's look at it together really quickly. And remember, we've got the JOLTS numbers coming out in 16 minutes, which I think will be quite important. So 2022 net income 2.6 bill, unrealized gains. So this does not actually affect cash right here, right? So they add that back in, their loss. Let's see here. Stock-based comp doesn't affect cash either. What do we got here? Cash and cash equivalents. So net cash by financing, cash, beginning of period, end of period. Yeah, I mean, they actually had a positive movement in the amount of cash that they had. They actually added 272 million in cash, despite having such a large loss. It's not really a substantial move, though. So, all right, we'll see what happens next quarter. I think, again, I still go back to my biggest concern right now with Uber is what happened here? Why did you 2x your revenue, but 2.5x your cost of revenue? Now, cost of revenue, without looking at the annual report, is usually what you're paying your drivers, right? So this is like your driver split. And if you're having to increase that and trying to get more drivers, this isn't necessarily the ideal trajectory that you want to be on, because that means the more users you get, the more you're actually burning money. And remember, they still lost money even if you add back in their impairment. So again, going to take a little bit more of a deep dive, but just an initial glance there, it wasn't super jumping up and down about that. Okay, again, we have in 14 minutes JOLTS numbers coming out. I do want to mention the 5-year break even right now is hide myself here for a moment. 5-year break even, you can see it here in the corner, slightly ticking back down again, not as low as where we were at 2.73. So we've still got a little bit of work to do to massage that break even down. Very, very important that break even goes down to really provide evidence that, or to reiterate that inflation is indeed, going to trend down. Expectations almost always come first. Okay, going back briefly here to the markets, we've got a NASDAQ roughly flat. That's pretty good. Enphase up 2%, Tesla up 1%, volatility up 4% right now. Seems like the market's going happy, which is awesome, despite the fact that you have this overhang of Nancy Pelosi. Nancy freaking Pelosi. Now we've also got Fed. Okay, well, it looks like we've got Fed speak happening right now. Daily just came out and said that work on inflation is nowhere near almost done. Fed Daily says we are still resolute and completely united on achieving price stability. All right. Daily says a long way to go on that ask. This is just the Fed for you trying to talk down the market again. I don't actually think it's working. Actually, you could just look at the charts and see that it's not working, which is great. Is the bottom in? That's the big question. A lot of people would actually say yes. All right. So we're now 11 minutes from Jolts. Let's jump around here. You know, what's really cool is we can look at a little bit of Bloomberg here and jump around to the parts that we want to listen to. Let's see what we got.
More supply coming on in September and October. And critically, I think that would be a reallocation of some of the underperformance by countries like Nigeria, Angola, and potentially even Russia, to those countries who can actually boost output. Like,
it's great.
Let's briefly listen to the Taiwan part here.
Joining us now, Victoria Green, a G Squared. Victoria, great to catch up with you. Off the back of earnings season, I'm just reading your note. You're calling this irrational exuberance over middling numbers at best. Why is that?
Because none of the results have actually been that great, and they've still been rewarded. Look at Uber this morning, that they didn't actually beat on revenues necessarily, but everybody's excited because they might make money down the road. And so I look at this, and it's the battle between irrational exuberance and irrational misery. So obviously we have some sort of misery index, and you have the Walmarts, the Targets of the world warning about, okay, consumers are really feeling the inflation pinch. They're changing, they're stopping. But John, on the same hand, you have Amazon and Visa and Amex and Louis Vuitton coming out saying, hey, no, we're making lots of money. Our customer base is healthy. And Amazon's customer base does skew a little bit wealthier than, say, Walmart's. So the problem is we're setting up this battle of Main Street versus Wall Street. But if Main Street breaks, then the consumer spending breaks, and consumer spending 70% of GDP. And so I really look at this and think that this rally has gone a little bit too far. So very nice to recoup what we lost in June, but the fundamentals really don't necessarily speak for a continued rally.
Can we learn something, though, from how this market's responding to some of that weak data, both the economic data and some of the pockets of weak earnings that you've illustrated? And that's essentially the point that Marco's making over at JP Morgan. Victoria, this is what he said. I'll repeat the quote. Whether it's earnings or the Fed, we see a reset of investor expectations. Risk markets are rallying despite some disappointing data releases indicating that bad news was already anticipated. Victoria, what if he's right? That we've priced this. It's done. Now it's rally time.
But it can't be priced in necessarily. Let's do market math. So let's say we have a 228 EPS for 2022. At an 18 times multiple, that's 4103. That's right where we are right now. And so I don't know how you can say it's priced in when stocks are trading where they are. And it all depends on where earnings comes in. So yes, we got too bearish. Absolutely. We had a relief rally. No doubt about that. But how can it sustain it? Because you're not going to see the earnings growth necessarily. X energy specifically, it hasn't been, I like to refer to it as the dumpster fire earnings. It's been better than that. It hasn't been a disaster, but that's not necessarily good news. Just because it didn't disappoint you completely doesn't mean it wasn't still a bad earnings season. So I look at this and say, yes, things didn't get as bad as it could have been, but that doesn't necessarily mean we're going to see the earnings growth to support multiple expansion and to support the S&P continuing to rally. You would really
All right, I'm going to pause there for a moment. I mean, to some degree, it obviously she's got a little bit of a bearish tilt here, but she's not wrong in that. Yeah, you can have some outstanding names, but if you're looking at the S&P broadly, you could see the S&P falter if Main Street falters, right? If people stop spending money, you could see the S&P really relax, which could mean that there's still some potential downside ahead, which was very interesting. But if you're talking about those individual stocks that she mentioned, I mean, I was blown away by what I saw from Amazon. Really excited by that. American Express, Visa was another one that she didn't mention. Also, just killing it, and really telling us that this is like the tale of two cities. She sort of alluded to this too, where it's like Main Street versus Wall Street. It's kind of like, I think really what she means is like the affluent versus the not, or like the upper middle class and upper class versus like the lower class, and that's why you see Target and Walmart getting hammered, but not so much, or even Best Buy getting hammered, but not so much Amazon, which actually appeals to a little bit more of an affluent customer base. We are getting a little bit of news here coming through from Daily. She's still yapping. Daily expects to have a slightly cooler labor market. Yeah, well, remember, we have the JOLTS indicator. JOLTS comes out at 7 a.m. PT. 11 million openings expected. All right, let's opening this. Oh yeah, and for the person who donated $5 saying, have you had the idea of streaming on another platform where I don't need to keep my phone on, like Twitch, where I can listen but not watch? Yeah, so that's actually YouTube Premium. I think it's like $12.99 or whatever a month. And this is like, it's not. I think the ad revenue is actually less when you use YouTube Premium, but it doesn't. It's just for your purposes. It's so worth it. Like, you could just be working out at the gym and lock your phone and just be listening. It's so great. And no ads. Like the stupid, like, skip, the 4-second play ads. You still have to listen to stuff like, go to metkevin.com/Webull to get up to 12 free stocks worth all the way up to $3,000, right? Still have to listen to that, but, we'll try to keep those to a minimum. Anyway, Daily is coming out saying, oh, yeah, let's quickly throw this up. There we go. All right, so Fed Daily expects to have a slightly cooler labor market, says I expect to have a slower economy. Let's see. Fed Daily says, my model outlook is we raise interest rates and hold them there for a while, looking for incoming data to decide if we can downshift the rate hikes or continue at the current pace. Daily says getting too confident that we've already solved the problem would be a mistake. See, this is again the way of again trying to talk the market down a little bit. Oh wow, it actually worked. Look at that. If you're listening, listen to this. NASDAQ takes a turn right back down. NASDAQ runs straight from the opening up to about $315. U-turns now sitting about 313. Straight arrows down here. Very interesting, because I mentioned that usually it's around 15 minutes that like the buying stops. It actually looks like it took about a little longer this time, like 19. This is very interesting. So you're getting a little bit of a talk down here. QQQ now down 0.6%. SPY now down 0.7%. Fed Daily does not see a large increase in the jobless rate coming. Okay, that's a sign that they could continue to be hawkish, right? There's some layoffs taking place as the economy rebalances. Yes, we know. We also have this Flight Trader 24 listing the destination of the U.S. Air Force transport plane, call sign SPAR 19, as Taiwan. Interesting. So, and Nancy Pelosi could be, so this could either be Daily talking the market down, or the fact that we do now have the destination of a U.S. aircraft transport plane listed as Taiwan. Tesla, interesting. This run up to about 903 here, now turning red at 891. We are 4 minutes away from the JOLTS indicator, which let me just give you a preview. If it comes in high, it gives the market or the Fed more reason to be hawkish. If it comes in low, then it's maybe a sign that, okay, what the Fed is doing is working. Do keep in mind, we have some phenomenal companies reporting today. And there could be some huge movements in some of these stocks. Wow. Okay, these are going to be very interesting. You have AMD reporting at 4:10 Eastern. You have PayPal reporting at 4:15. Now, PayPal has absolutely been getting trashed. And so there's a potential for a huge movement on PayPal. Let me see what the expected movement is for PayPal. Yeah, they're expecting an 11% one-day movement in PayPal. Very interesting. You have SoFi coming up. SoFi coming up. It looks like there's no time given, but after the bell. Airbnb 405, Starbucks 410, Warren Buffett's Occidental Petroleum. Boy, that should be a good one. OXY. Gilead Sciences, EA, Match, Caesars Entertainment, MicroStrategy, Solar Edge. Ooh, that could be a mover there for Enphase too. Woo! M-Chip. Lots of earnings at market close today. Really, really interesting. Whew. Okay. So daily does not see a large increase. Okay, yeah, that's not nice. All right. Next. We are 2 minutes away. Does that mean we need some suspenseful music again? I don't know. Do we have any suspenseful music? Oh. We certainly do. Let's get this up. All right. So really, the market somewhat all over the place right now. You've got what looks like the NASDAQ trying to pop back. It's only down about a third right now. Tesla up 0.5%. So you've got a lot of volatility. The market's really unclear as to what it wants to do in terms of up or down here. So who knows? Maybe the jolts will give us some confidence. Again, this is a tell. Is the Fed going to be looking at this? And we know the Fed's going to be looking at this. So I should rephrase that. We know Jay Powell is looking at this number. If Jay Powell's watching this right now, what's up, Jay Powell? But yeah, it's the survey again shows 11 million job openings. A hot job openings number with many job openings means this economy is still going. And it also kind of gives some credence to this argument that, like, how could we be in a recession when we keep hiring like crazy like this? And so it is very odd. I mean, I think we're in a recession, but I've been saying that for quite a while. It's why we've been talking about a technical recession and a paper recession since February and March about how we can push down consumer data. So we'll see. Here we go. Okay, 5 seconds. Here it is. And 11 is the expectation, and it is. It's down 10.698. There you go. 10,698,000 comes in well under the survey. That's really good. Shows that we're seeing a reaction here from the Federal Reserve in labor markets. That to me is a data point that actually supports the Fed is on the right path. The Fed does not necessarily need to keep being all crazy hawkish. This is good. This is a good thing. That is a very good number. We did have last month revised up by about 49,000, but that's nominal compared to this miss of 302,000. We had a miss of job openings by 302,000. It's a big drop of over 556,000 job openings drop from the prior month. That's about a 5% shave down of job openings. So all the job openings you had, 5% cut. And again, this is a miss. Economists expecting 11 million job openings. We got 10.698. That to me that's a bullish. That's a reason to be bullish, in my opinion. This market's not really reacting to this. We've kind of got stability at the QQQ. You've got stability over on some of the other stocks that we're watching. Volatility still at 5% today. Let's see maybe if the bond market's reacting at all to this. But so far, I'd say this is actually good news. Bonds right now, we've got the 10-year basically flat at 2.6. You've got oil at 94. That's the Western. And then, of course, Brent sitting at 100, where it's been sitting for a while. Let's see if the suits have anything to say about this data release. All right, let's listen in to the data release.
Though she does certainly say as well that the job is far from done. The data does come in a little softer than anticipated. 10,698,000 is where we stand. The market was looking for around exactly 11 million. The previous number revised a touch higher. So we are seeing a slowdown in the job openings, but they remain at historical highs. So one needs to be aware of that as well. Let's lift the hood on this data. Let's figure out what's going on under the hood, what the jobs market is telling us. This, of course, as well ahead of the payroll number that we're looking for Friday. We are expected to see a slowdown. We're going to be looking very carefully, as well as what is happening with the claims number as well, just to get an idea of what is going.
Worth noting, that's true. We have the jobs data coming out, the unemployment rate on Friday, right? But I have to say, as far as this one, I don't know. If I had a song that kind of sounded like markets just got clapped, or no, I shouldn't say markets got clapped, that estimate got clapped, it probably goes something like this. I think it's a good thing. I think it's great. This is wonderful. And if we get red off of this number, it's a blessing. If anything, the reason we're seeing red right now is because you've got Nancy Pelosi presumably now on the way to the capital of Taiwan, as we do have a flight that we're tracking that has its designated as is a military Air Force transport plane that does have a destination listed as the capital of Taiwan. That is probably weighing on the market right now. I see that as an opportunity, because really what you have is you have the short-term catalyst, which is uncertainty about, oh no, what's China going to do? Weighing on markets while Nancy Pelosi is flying over to Taiwan. Well, at the same time, we're actually seeing, the Fed's work is working. So to me, I'm happy about this. I look at this as, make some money. And if you need a reason to buy the dip, you've got a 0.5% decline here on the NASDAQ. I don't know. I'm not opposed to this. So yeah, I don't know anything about Mullen. Sorry to hear that, God Pill, about something about some insiders doing some shady things there. Sorry about that. I don't know anything about it. Appreciate your $50, but I don't know anything about Mullen. I hate to say it. Maybe it's something we can look into, though, but we wouldn't do that live. We got about 5-ish minutes to go. Let's just kind of, what we should do now is let's clean up some of the TA that we've gone, okay? So let's do that together here. And let's first of all see if we can get this fib line cleaned up here on Tesla. That would be very nice. It's incredibly difficult to actually grab the fib lines on here, though, once you've drawn them and locked them. But the good news is you can still get up to 12 free stocks with this software by going to metkevin.com/Weevil. Drawings? No. I will one day figure out how to unlock these things once you've locked them. But anyway, I'd like to draw the Tesla fib a little lower. Yeah, because we do need to clean up some of these lines here a little bit. The wedge that we talked about earlier, I think, is very, very impressive, though. And it shows you an example of a perfect kind of breakout wedge or lead up to a breakout. And these are things that you want to pay attention to. This is what I did on gold earlier in the year. And it worked really well. So it's not perfect, but we're trying to see really this increasing wedge here where you're getting, whoops, there we go. Where what you're really getting is you're getting these higher highs, but also higher lows. Created this little wedge here on Tesla. which led to this breakout, which we've recently seen along with the market. You can probably draw that even lower, but that's okay. And I like this. It's not even so much of a wedge here. This is not. It's a nice little trend, an uptrend here. And we got the little breakout from trend. There you go. Now we're really sitting right around our purple line, which is a little tough to see right now because we've got this darn Fibonacci in the way, which I can't seem to remove right now because it's locked. And I'd love to get rid of it. But anyway, this the purple line is sitting right at 890, really big one. Someone here says, let's look at gold. Yeah, let's look at gold here for a moment. So how interesting. Yeah, look at this. There's my converging pattern here on gold. And look at this. This is when I actually bought gold right over here in early February. I saw this pattern. I'm like, wait a minute, look how long this has been going on. And for me, this was a perfect opportunity to buy gold. And I ended up selling gold roughly around here when Putin invaded, which I think was right here at like 37 IAU, somewhere around there, 36, 37 IAU, and bought somewhere around, 33, 34. Gold doesn't move terribly much, right? I mean, you got this extreme movement here from 38 to 39. It's the same thing with like a dollar move. So oftentimes what you can do on these plays to leverage a little bit is you go in the money calls. Right now, I'm also going in the money calls on UDN, for example. I'm calling it the Great Dollar Short. And it moves very, very, very slowly. But so far, it's been moving well. This is about right here. I think I bought at 1770. And so this is an inverse. So that's why it looks like the opposite of what I'm saying. But this is an inverse ETF right here. And it's called UDN. So when you buy it, you're actually shorting the dollar. I've got to make a larger video on that in terms of the research I did here. All of the research has already been posted for course members. And you could see my full PDF with all of my research from when I started this short over here. Okay, so which again is a long on UDN. All right, what else do we have going up? How are the rallies going that we had this morning on things like Uber and Pins? So Pins relaxing a little bit from after hours. Yesterday's after hours, it was up around 20%. What's remarkable about that is after hours, you seem to get so much excitement, but then you get a little bit of that fizzling later on, right? So you want to be careful with after hours. I don't know many who get great deals in after hours. Amazon over here, kind of flat on the day. It's one that I'm paying attention to, but not in. And Ethereum, let's take a brief look here at Ethereum. Ethereum down 3.3% here in the last 24 hours, sitting at 1575. Okay, what else? Let's see if the suits have anything for us. Last check here of the suits. Jolts misses for the first time since January. So this is what we had talked about earlier. I appreciate the donations here on Mullen, but yeah, I can't make any kind of commitment right now on anything. So I'll look into it. And maybe Godpill here is very excited about the Mullen squeeze happening soon. Okay. So Jolts misses for the first time since January. The data showed a steeper than expected drop, which we did cover at the 10.68 mil as the numbers came out, broadly consistent with the narrative of a gradually cooling labor market, evidenced from sources as diverse as claims and the Beige Book. Claims would be the unemployment claims, which come out weekly, though we're still dramatically under trend for unemployment claims. I want to say in the 2006 to 2007 era, like right before the 2008 crash, unemployment claims were averaging over 300,000 a week, and right now we're sitting somewhere around 240 to 250,000. So we're still low on unemployment claims. So I think that's the correct way to look at it. Is you're seeing a gradual decline of the labor market, but it's by no means like a crash of the labor market. Okay, cool. Well, that does it. Welcome back. Thank you so much for being back to a Market Open live stream. We'll see you in the next one. Goodbye.